Here we've talked about institutional investors, but who really makes deals come and work, that does the greenfield investment, that really helps ignite the deals we need to finance? It's really the banks. And of course, we've had a wonderful phenomena of the growth of African banks. And so I'm really pleased to chair this session, which is going to talk about the planning and strategies of African banks, how they've been successful to date, and what do we need to just keep on growing that success so we can get more deals done. So we only have a few minutes because we have to end on time. So we will move quickly into Q&A right now. Yes, Ashley.
Hi, gentlemen. It's a fantastic panel to see you all together. I work for African Alliance. I represent the investment bank here in America. And I'm proud to say that we actually worked with Helios on the sell down of Equity Bank to the NSSF very recently. My question is to all of you. You're all growing your platforms across Africa. If you're going to do it organically, that's fine. But a lot of you are doing it by acquisition. And there's only so many good banks out there, or only so many banks that don't have enough capital that could do with your injection. How are you going to do that successfully without giving too much away to the rest of the panelists? I'd appreciate some perspective. Thank you.
Well, part of the question that I'd like to answer is I don't think that all the banks are growing just by acquisition. I mean, in our case, we've got brownfield and greenfield, and growing with starting an operation as well. So it's a mixed. It depends on the opportunities that present themselves, and then the banks look at that. So it's not always acquisitions. Sir.
Okay.
Yeah, you're on.
I do. Okay, I think it's similar with us. Of our 9 franchises, we've done 4 acquisitions and 5 greenfield. So it depends what the opportunities are. I'm actually very open. We're going to Tanzania, we're going to go greenfield. We're going to look at Mozambique, maybe we'll do an acquisition. I think there's still, in most high impact countries in Africa, a lot of small banks. And what you find is that as capital increases are happening, a lot of people who open tiny family banks are realizing that they have to get out of it, and that there will still be opportunities. I'm a very timid person, so I'm actually very scared of acquisitions. Due diligence never reveals everything. So it's a real balance. But I think that if you wanted to grow by acquisition, there are enough tiny banks in a lot of the countries where the family owners need to get out of those banks.
I think it requires a balancing act because one, scarcity of skills and competencies. In some markets, particularly challenging markets, if you get an engine that is functional with the right human capital, it becomes easier to enter. But equity in the 6 countries, we have only entered through acquisition only in 2, Uganda and DRC, so essentially.
I think if I can just comment, I think our strategy so far has been acquisition, and obviously Nigeria is a unique market, but typically across the countries where we're going to have presence, we've been pretty firm that if we're not in the top 3 to 5 position, we don't want to be in those countries. So organic growth and acquisitions is going to be a natural way to go about it. To Segun's point, due diligence and etc. is challenging, and therefore I think that's the bigger opportunity. So if you're able to do that well, and if you're able to then integrate that into your bank overall, I think but there's plenty of good deals out there, to the point of people want to be a part of a bigger picture as well. So it's not necessarily fully exiting people all the time.
Another question? Yes, Mahesh.
It's a pleasure to be able to ask a question of a market where I'm active. I'm advisor to one of the banks in Nigeria for 5 years, another one for once in the past, so I know a little bit about the banking system. What I'd like to ask you, and also it's great to be in the presence of maybe the only billionaire we have attending the conference today. So thank you for being here. Maybe there are more. I don't know. Given the valuations in the market, perhaps there are. You talk about equity markets and 25% growth and 30% growth. Yet the banks in Nigeria, most of them are rated. Well, the big ones are rated. Zenith, GTB, UBA, Access, Union Bank that you own. They are rated, but not very highly. When you talk to rating agencies about 30%, 40% growth rates, they shudder. When you talk about equity markets, they love it. So how do you balance the need for capital through equity, for which you need the growth, versus the confidence that the rating agencies need to have to give you the top ratings that you need for other kinds of financing?
Okay, let me try and help out here. First things first is, you know that your rating can't be higher than the sovereigns. So if I could be cheeky, I'll say that my rating is constrained by Nigeria's rating, and that if it wasn't for Nigeria, we'd have better ratings. I mean, we have NPLs of below 3, capital adequacy tier 1, 21%. We tick all the boxes, but we're predominantly a Nigerian bank, so we're constrained by the sovereign. But rather than sell my franchise for cheap, which I alluded to, the profit is strong enough, where if you keep your dividend payout ratio at about 50-55%, and you're putting back in capital about $350 million a year, then guess what? We'll never need anybody's equity until the day we get the ratings we want.
I think if I add a little bit there, investors are now going beyond ratings because they're also ranking and comparisons. If you look, for instance, globally, the banker, Equity Bank last year was rated the 4th most efficient bank in the world. I should have said with a return on equity of 35% and a return on asset of 6%. So essentially, then investors go beyond these ratings, and how do you rank these investments in terms of return? When you look at solidness in the same rating, Equity is ranked the 68th most solid bank in the world in terms of ratios. So the ratio speaks more than rating because of that constraint. Equity Bank will never be rated higher than the Kenyan rating. So it is not the African banks that are rated, it's the African countries that are rated.
But just to build on that, I think when you think about capital markets as a whole, in Europe, 80% of banks' debt sits on their own books, whereas in the US, they've securitized it. So I think thinking about developing our capital markets down the line in terms of securitization, et cetera, is going to be playing a crucial role as well, and that will, I think, help on an overall perspective, which I think is important.
I think my colleagues have already discussed that ratings cannot be better than the country where you operate out of. So that's one piece. And then, my take on this is, where is the beef? Investors really want returns. Obviously, the ratings are constrained, but ratings don't necessarily mean that we don't have the kind of returns that the investors want. So.
And we see for the local pension funds, that's not an issue. Yeah. So we had a question, I believe, over here. Okay. Oh, sorry.
Good afternoon. Ellie Page Jabrell. I'm based in Washington, D.C. I'm a strategist and advisor to the public sector and private sector on 5 continents. And my question is really for the panel, where we're hearing about some of your customers who are taking fixed assets and getting loans and really shopping around from one bank to the next and not really having an infrastructure for the banks to know who's bringing free and unencumbered collateral or assets. I'm just curious in terms of how you might be discussing amongst each other to know that you really have verifiable retailers and loans as well.
If I talk about Kenya, the situation is not as may be reflected. We have a comprehensive RAD registry, which all mortgage registry. And also, all these are registered also along with the business registry office. And if it is assets backed like let's say things like vehicles, again, the registry is very functional. In addition, we have credible reference bureaus that have both positive and negative information on our clients. So we no longer need to compare between ourselves because the registries are functional.
Okay, well, in the case of Nigeria, it's funny, it's still two stories. In the corporate space and probably middle market where you have hard security, that's not really a problem. The land registry has everything and mortgages are registered. The bigger problems when you go into the retail space because you don't yet have, like Kenya, a sophisticated credit bureau, which is why in the Nigerian banking system today there's a biometric project being done. We reckon we have about 30 million bank accounts, about 20 million people have been registered. So by the time we can tie you to your biometrics, then it'll be easier to start to build a credit history for retail. But in the other end of security, there's no problem. It's really in the retail, but I think we're probably 6 months away once we finish the biometric project.
Yeah.
Okay, we have a question here, and then I see another one in the back. You guys have inspired a lot.
Thank you. Ahmed Dumondé from Côte d'Ivoire. My question is, this is a very exciting story, and I'm very hopeful when I see and hear this, particularly on two fronts. One, the first one has to do with bringing essentially the millions of Africans out of the woodwork where nobody has a bank account, extremely difficult. So I would be more than happy to hear from what Equity Bank has done. How do you foresee being more aggressive, and certainly some of your colleagues here, in terms of increasing the ability of some of the millions of Africans who don't have a bank account to be part of the system? And the second thing is SMEs, and I'm glad that you really are emphasizing on that, because there's some very interesting thing happening. You have most of African countries now embark on this, doing business a program that the World Bank has to improve their, business environment. At the same time, there is difficulty for some of those SMEs that we are bringing from the informal sector to the formal sector to have access to adequate financing. So my question to all of you is that I guess the last panelist actually just spoke a little bit about that in terms of what can be done to essentially improve the ability of SMEs to have access to the financial market. Thank you.
Okay, well, I think he's more of an expert on financial inclusion than I am, but I'll try. I mean, the central bank in Nigeria has helped by creating what you call a Tier 1 account. It has limits, but at the end of the day, the KYC requirements are minimal. And that's why what we've done is, I told you we're partnering with a telco, and literally all you have to do is press *7370, and within 1 minute you'll open an account, and we'll use the documentation that you have with the telcos. So that is really going to push financial inclusion. From our perspective, you can come down in the pyramid. In terms of SMEs, just like I said, there's a lot of capacity building that you need to do. We cannot run away from SMEs. I always say, if you look in Nigeria, everybody's an SME. Even those in paid employment have SME businesses. So what you have to do is give them some capacity. A lot of SMEs have found don't even know the difference between turnover and profit, so they tend to run into trouble. You have to give them other platforms where they'll grow. And so working with things like the World Bank, the IFC on professional capacity building for SMEs. Also, the central bank has a fund called MSME Fund, which has like first loss guarantee. So we're going to have to take a bit of risk on the SMEs, but we're going to have to give them the capacities to grow, and there's no running away from the SME business. For us today, it's only 8% of our business, but we're hoping it'll grow in the future.
I think the challenge of SME is not that it is not a big opportunity and a very good opportunity. It's the amount of effort that is required to bank SMEs. One, most of the SMEs are in the small and micro segment where they don't even keep books. So essentially what happens is that it makes banking SMEs labor intensive. You have to have the right people with the right attitude to rebuild and to reconstruct the books of accounts. The second one is building capacity in your clients. You have to invest in building your clients. Over the last 3 years, Equity has trained 1.3 million of our clients on a 12-week financial literacy program. And now we have embarked on the most promising 25,000 on a 3-year entrepreneurship program. But that investment is worthwhile when you look at that segment. Because it's, banks are not very good at it, we're able to maintain a net interest margin of 10 to 11%. And we're also able to make 45% of our income from non-interest income, despite that. So essentially, what you really need to do is to be committed to invest in that segment, to unlock it. So it requires upfront investment. And then it builds enormous loyalty. Our top SMEs have now been with us for maybe 15 to 20 years. So they are in cycle of 12 to 15 times of borrowing. So you have sufficient information on them. You have helped them build their asset. You have built their trust and loyalty. And then it becomes very, very easy. But upfront, you have to have the capability to train, capability to construct the account, and particularly from expenses, not from books. It's by discussion. So that is the hard part of it, but it can be done. Lastly is that you have to have understanding regulators, because when regulators create regulatory frameworks and requirements that are punitive to banks because of banking SMEs, then banks become shy. So Kenya, we have been very lucky that the government has digitalized the national identification system. So you can log in and be able to verify almost everything about the registration. And second, has adopted what one would call smart regulation to encourage that segment. If you look last week, but one, they created now a Companies Act that focuses on SME other than the traditional corporate companies. So that is support from government and regulatory framework makes it possible.
I think if I can just add, I think the technology angle is absolutely crucial. So, bringing the informal sector into the formal sector. I mean, we have a mentorship program across the continent where we're supporting over 1 million entrepreneurs today. So I think it's the whole ecosystem approach of how you've got to really look at it. And if you think about a lot of the banking sector across the continent historically has been, taking customers' deposits and putting it into government treasury, not typically lending to SMEs. And I think that's a huge opportunity which, some of the panelists on the table are addressing and needs to still be addressed in a huge way, because that's really going to be our answer to really building the economy as a whole as well. So genuinely doing good and doing well combination, which is trying to create a bank for business in the true sense.
So my colleagues have basically covered the whole spectrum. I would just add also that there are good examples that we can take from. For Grameen Bank in Bangladesh, you're talking about microfinance. It's an example out there that can be utilized by institutions to go there. But there's a long way. There's a long way to go, and I think all the institutions are working hard on that challenge.
It's really tough here. I've been told the next panel is here. We're on a very tight deadline. Can I encourage you to meet up with the person or persons you want to ask the question with? And I'm sorry about that, but it's like, this is extraordinary. And, we have a wonderful future. We've got to really thank these guys for sharing with us. Unbelievable. And I want to see how many people our friends in the development partners have trained versus your, what was it, 1.5 million?
1.3.
1.3 million. A special clap for that. That's one of the things.
Doing business in Africa. You can't afford to be without Africa Investor.